Bonjour, good afternoon. As you're settled down, I hope you had a chance to view the video. There is one figure from this video, which is a global tracking exercise of the public and private capital flowing into nature-based solutions that is key, is critical for this discussion. And this figure is 17%. So that's the share of private capital invested into nature-based solutions, while the remaining 83% is from private source or governments. 17%, that's the private capital flowing into nature-based. It's small, rather small, too small. As investors, finance experts and practitioners, so we are here to discuss how we can scale up this percentage from 17, aiming to have a parity at least with public sourcing. So this session, which is organized by UNEP and IUCN, I'm from UNEP, I'm Aurélia Blien. My colleague from IUCN, Jillian, is here. So what we're doing is often what international are playing in this scene is we are convening and coordinating exchange among peers that allow you to dialogue and see how you can gain insights from innovative financial mechanisms, from investable business models, and also from what you've been hearing this week a lot is this nature positive investment. So how does it translate into a monitoring and a KPIs? So this session, which is a dialogue and a knowledge exchange, is really meant to be your sessions. So please be part of it. We want also to be hearing you. It's not only about the panelists that we really thank you, but it's also about understanding the whole market as such. The dialogue is going to be facilitated by Rachel Hemingway from the Climate Bond Initiative. We thank you for this really important role, and the floor is yours, Rachel.
Thank you so much. I'm really pleased to be here today. We're going to be talking about nature-based solutions. I'm going to just start by providing a definition for those because the concept is not new. Nature-based solutions are actions that harness the power of ecosystems and nature to address social and environmental problems, things like biodiversity loss, climate change, and others. I'm joined by 3 experts on the subject. We're going to try to focus today on clear, specific examples of what has worked. We're going to be talking particularly about nature-based solutions in the context of agriculture and forestry and land use. I'll give a couple of examples to start with of nature-based solutions. Maybe most people are already familiar, but for those that are less familiar with the concept, I think the one that is best known is, for example, planting trees to absorb carbon from the atmosphere. That is a nature-based solution. Another one would be using wetlands to purify water. So it's very simple. Using the power of nature, it's low cost, there's multiple benefit flows, it's low maintenance, and there's lots of interest in the subject right now. But we have had some interesting discussions about how to make it scale up. There's lots of examples of where it's been working in local contexts, but I'd like to introduce my panelists now, who will be talking a little bit about structuring these innovative financial methods and establishing revenue flows, and then a little bit about scaling up. So we have, to my right, Nick Moss, who is from Agri3. Then we have Jose Pugas from the JGP Asset Management, and Stephen Ripley from the Sustainable Investment Management. So we'll have 2 panels. This is the first one. It will last for 15 minutes, and then we have some time for Q&A, and then we have another set of panelists coming up for a second session, so it's going to be quite quick. And I'll turn first to you, Nick, if that's okay. And I'm interested in understanding what are some of the benefits that you've seen in these nature-based solutions. How are you identifying your investees in this area? What are some of the things that made the process easier for you?
Yeah, great. Well, thank you, first of all, for having me. And it's great to join friends and colleagues on this panel as well to have this discussion. So for a bit of background for the audience as well, so Agri3 is a financial mechanism established, or a fund that has been established 3 or 4 years ago now, initially out of a cooperation between Rabobank and UNEP, funded by the Dutch government, Conservation International on behalf of the Global Environment Facility and Rabobank itself, and established in order to mobilize financing from commercial banks and other investors in the market into forest conservation and sustainable agricultural models globally. So we are slightly unique in the market in that we're really focusing on working with larger financial institutions in order to mobilize pools of capital from those larger international investors or even local institutions into projects that would usually fall outside of their risk tolerance. So that is that we provide subordinated debt or even guarantees that will help these investors to step in. That means that we can operate with a mezzanine tranche, we can operate by extending tenors of loans, we can operate by taking on certain risks that maybe fall outside of those financial players. So for us, whenever we're looking for investors, we're looking at investees, we're really trying to work with a financial institution and through a financial institution to help them to identify projects as well. And that in itself is a challenge. So to your question, when we are trying to identify investees, we're trying to first of all identify a financial institution and demonstrate to them the benefits of investing in nature-based solutions to start with, which in itself can be a challenge when operating with larger commercial banks, for example. And then we're trying to demonstrate, identify investees on the ground, project developers, farmers that are willing themselves to take that next step in their sustainability transition. And we typically work with them to develop an action plan and KPIs, which they can then deliver on over a set period of time as well. So for us, when it comes to what we have to do is the benefits of things as well, we have to try and really demonstrate to a financial institution that there's a benefit for them in taking this journey, that they can offer different financial products, and that there is risk that is going to be mitigated at the end by their clients by taking on these different solutions with their clients. And then to the end client, that they can generate additional revenues, that there's benefit for them to meet regulations, and of course that they can demonstrate to their own investors and stakeholders that meeting these requirements will help them to generate better revenues and longer term growth as well. So for us, we have those dual challenges really. The financial sector in itself, and then trying to find good investees that want to do it.
Thank you. So I'm hearing about the importance of partnerships here, and I'm hearing about the importance of de-risking. And I'll pass the same question over to you, Jose. I'll just repeat it so you can remind you. How are you identifying suitable investees, and what is making this process easier? And would you like to reflect on anything that Nick has said?
And I would like to stress that the challenge most of the times is on the financial sector, is not on the project itself. I think that the hardest part of finding a suitable investee for us is because most of the times we are trying to find ourselves on the investees. It's not an existential crisis or nothing like that. It's because we create the mandates for our financing before understanding what is really happening on the ground. So we try to adapt what is happening on the ground to our mandates, and it is impossible. The money can't get at the territory before the production, before the investee, and most of the times that was happening. There's a lot of capital to be allocated on nature-based solutions, but most of the capital doesn't understand what is a nature-based solutions and try to change the nature-based solution to suit their own desires and mandates that were previously sold. This equation will never work. So what we are trying to do is to co-create mandates with the investees. So we don't set up funds before we have a pipeline. So we structure pipeline, and then we create a fund. Then we create a mechanism. And if the investors are not okay with that, they don't think that is suitable, most of the times it's because they do not understand what is happening on the ground as well. So we try to educate them. For sure that we need a lot of de-risking tools and de-risking mechanisms, but what we have identified is that the best de-risking tool is investor education. Because the risk of ignorance, the risk of not knowing in what you are investing, you start mispricing the risk, and they start being prohibitive. And the cost that you use for de-risking methodologies, sometimes de-risking tools, are even higher than the impact that you're creating on the ground. So in our opinion, is the best, what make it easier for us is to cooperate with the ones to be invested and create good histories to be told, good stories to be told to the financial sector. So we select, mostly on bioeconomy that we're investing, we selected 9 non-timber forest products, and we selected the champions of each of those supply chains, and we are creating mechanisms for each of those. So at the next time, when someone from the financial sector wants to invest on the supply chain, we can show there was once upon a time someone that was able to go to the capital market, get access to capital, and be a successful story. And the risk, the perceived risk, will reduce immensely. So that's how we're doing to make it easier for us to find investees and to fundraise investors.
And again, I'm hearing the importance of partnerships and working with others both up and down this supply chain. So Stephen, over to you. The same question. How are you identifying your partners, your investees?
Yeah, thanks. It's a great question, but if I may, I'm going to take a little step back and just think for a second about the why, which I think is always a good starting point. So, as most people are aware, we need to cut carbon emissions by 50% in 7 years. Now, stopping deforestation has been identified, or tackling deforestation has been identified as potentially delivering 22% of the climate mitigation required. So that's a quarter of the reductions in emissions that the planet needs. Now, I work for SIM, but we specifically work on something called the Responsible Commodities Facility, and this is a mechanism to tackle deforestation effectively at zero cost. It's an investment. So, again, just giving you a little bit of context, the target area for us is the Sahara region in Brazil. This is a region which is about 50% of the size of Europe. It has about 5% of the world's biodiversity and still retains more than double the area of France of native vegetation and forests. So now I'm sure you're eager for me to get to the point of how does RCF protect forests? Well, quite simply, we provide low-interest credit lines to the farmers that own significant portions of this forest. There's one condition that comes with our finance. There can be no conversion of native vegetation and no deforestation. So then how we make these loans investable is that we securitize them and then we list them on the Vienna Stock Exchange so that our investors can acquire these, what is effectively a green bond, and it pays an annual rate of interest, and you get all your money back, very likely all your money back at the end of 4 years. And that was that relates to my comment on a zero-cost option for tackling deforestation. So, very briefly, to summarize, the real effect of this mechanism is that forests that were previously not protected at all under any regulation because they were forests that were over and above the legal minimum. I'm sure many people here are familiar with the forest code in Brazil, which requires farmers to maintain 35% in the Cerrado as forest area, but we're sponsoring farmers that are doing more than that, that are going beyond that, and asking them to conserve all of their forests, even over and above the legal minimum. Excuse me, and as I say, converting these loans into an investable product. Now, I'm very happy to say, if you just allow me one more minute, that we've successfully leveraged the impact investors who initially catalyzed this initiative. So that was the big supermarkets in the UK, Tesco's, Sainsbury's, Waitrose, who collectively invested $11 million in this initiative to kick it off and demonstrate that it was viable. Today, I can announce that with the support of, with the very gratefully received support of Agri3, we've managed to leverage a total of 47 million with the participation of Rabobank and Santander. And this is fantastic news. You know, we can start lending to many more farmers, over 100 farmers, 122. But we're still not there yet. We can't sit back and relax. The funding requirement for agriculture in Brazil is many billions of dollars. So that's the scale we need to reach ultimately, and we need more impact investors. Thank you.
Thanks, Stephen. I'll add another statistic to your number. You mentioned 22% of carbon, the needed carbon sequestration from reducing or eliminating deforestation. For all nature-based solutions, it's estimated that they can meet 37% of low-cost carbon sequestration needed by 2030. So it's a massive opportunity here in nature-based solutions over and above deforestation alone. We have a couple of minutes left, and then we're going to go to questions from the audience, so please get your thinking caps on and get ready to raise your hands. But final quick question to each of you is, are you seeing changes over time with this? Are you seeing changes in terms of the ease of working in this area, in terms of the appetite for investment in this area? So I'll go with the same structure again. Come to you first.
Yeah, I think there's many ways to answer that question. I think some people in the audience will know there's increasing investor appetite to look at these types of nature-based solutions, which I think is great. So on the capital raising side, it's becoming easier. I think on the project side, there's still work to be done. There's certainly lots of developers out there, but when it comes to the more probably, let's call it mainstream work of larger farmers, your standard farmer, in the agricultural sector, there's still huge amounts of work to be done. I think it's important to recognize that at the end of this, we are expecting somebody somewhere to make a financial change on their on what they're managing, what they're looking at, and those are not yet being properly compensated for from commercial or financial instruments that are out there. So whilst there is change and recognition, and especially from the corporate and financial world, that is great, it's not properly translating to pipeline that we can see, and indeed the ability to be able to make good, solid investments on the ground. We see lots of good examples, but I think those are still in the minority.
Thank you. Jose?
We were able to, if I look 2 years ago, we had less than $20 million in nature-based solutions in our pipeline. Now we have a little over $250 million in our pipeline for nature-based solutions. And that was the reflection, not because the ecosystem became more diversified, but because we started looking at the ecosystem through the ecosystem perspective. So many projects that we considered to be unbankable, after some love, they were bankable. We could accelerate them and make them become bankable. So I think that was really helping us and making the ecosystem much better now. Is that we are starting investing time, not just capital. Time for them to accelerate, faith for them to get right, and understand that to fail, it's good sometimes. We know that financial sector is very first to risk and failure, but that's the only way we learn. And finally, I think that blended finance is going a long way. The public-private partnerships are going a long way as well, but more than ever. the private sector, the real economy is at the arena, is at the game as well. So more and more we can talk to off-takers, to the food industry mainly, that they are responsible for their supply chains. And a lot of capital is coming through the corporations to the transition supply chains. And I think that will make much easier and the ecosystem much more bankable, as you like to say, for us at the financial sector.
Yeah, fantastic growth there, but as you said, we learn through failure and we need some patience. So over to you, Stephen.
Yeah, I think just to give another example from the Responsible Commodities Facility, again, thinking about these supermarkets, UK supermarkets investing in sustainable soy production in Brazil, if I would have said that to these supermarkets a few years ago, they probably would have asked me what I was talking about. But through education, through talking to them, through explaining to the many different departments of these supermarkets, we've eventually kind of transitioned them into the mindset where they understand that they can have more impact as an impact investor rather than making one-off grants each year. They can use the money, and it is effectively the same money that they were spending on soy sustainability in the form of credits or certification, etc. They're using the money in a more intelligent way, and now they are impact investors and supermarkets at the same time, and they're supporting the producers at the start of the supply chain. So I think this this development of the realization of the responsibility of all stakeholders in the supply chain is one of the most encouraging things from my perspective.
Amazing, thank you. So this is an opportunity for the people in the audience here to share experiences and ask questions. I see a lady in the red and white.
Yeah, a quick question on the potential implication of large corporates, and here I'm thinking FMCG such as Nestlé, Danone, and Unilever. Is there a space for your institutions to collaborate with them, considering that their Scope 3 emission reduction is going to be top of the agenda for them, and that I'm assuming it's an expensive transition for them, they might not be able to finance alone. Is there a space to collaborate, and how?
I can kick off just from a couple of our observations. So first of all, absolutely, the fact of the matter is that Scope 3 is a real trouble for them, right? And not just for the FMCG companies, but also for financial institutions that are financing agricultural players as well, which have Scope 3 within their own supply chains. And if you can imagine, financial actors have that same exposure for Scope 3 risk, without necessarily the levers that others may have, because being a off-taker and being able to offer long-term off-take guarantee, as opposed to just providing a loan, is a different lever, but they have the same risk associated. So it's a broad risk, and what is encouraging to see is that they recognize that. They don't know how to measure it properly yet, and that's part of the problem, and they don't know yet how to provide the incentives for it. But it is, we have noticed within our conversation, I'm sure others, including RCF, have, that risk is becoming more and more prevalent in discussions about how they can offer different financial products, different types of, and these, not just, banks, FMCG companies now, as a result of the agricultural roadmap, which came out of COP27, are now really looking at financing in their supply chains to encourage better management on the ground to lower carbon emissions as well. So you're looking now at different actors providing different financial streams to encourage with different incentives and to lever their...
So you're talking FMCG financing directly the type of projects you've mentioned? So
within the agricultural roadmap, there is a stipulation that the FMCG companies, or the big traders, which developed 10 traders, 12 traders came up with an agricultural roadmap. And part of that was looking at mobilizing finance.
Okay.
Now, the stipulation of that is not clear, but they will be looking for financial products and partnerships to do it. I think they will, there'll be trouble.
And on that side, for us, we are the Scope 3. So for us, it's most of the times when you want some investor from the global north, Europe or US, they want to make hard currency, not local currency. because of the currency risk. If you have an offtake agreement in hard currency, you have a natural hedge operating there, so it makes us easier. The second part is much cheaper for those companies to be an investor on a junior tranche of a blended finance mechanism and multiply their capital through commercial investors and become the first loss than to finance by themselves the transition. It's cheaper. And reputationally speaking, it's much better because when you look at a scenario, when you have UTR, when you have the litigations coming, you need to protect yourselves. And the best way to protect yourself is not doing that by yourself, but doing that in a collective way with local players on the areas in Europe being affected. So in every scale, for those companies, the best way is through sustainable finance. And the best vehicles for us, with all due respect to TFIs and MTPs, corporate venture philanthropy has been much more fruitful and dynamic for a blended finance mechanism than the traditional TFIs and MTPs capital.
Yeah, I couldn't agree more with what Jose just said. Absolutely, we need the manufacturers on board. We need the Unilevers and Nestle's of the world to step up, to put it bluntly, and we need them to invest. It is a clever way to invest your money. It is cost saving, and the potential costs that might be associated with future scenarios related to the deforestation regulation, which Jose mentioned, where supply chains become segregated and inefficient. I mean, the cost for manufacturers is going to be enormous if they allow that to happen. Whereas if they engage and invest and develop the solutions, you know, it's potentially cost saving. So, yeah, just to finish on that point, because it is a really important one. There's two big cost savings they can make. Start using your finance intelligently through investment, and thereby save yourself money in the long term when it comes to compliance.
Thank you. And I'll just add one more thing to that, is that the big players are now starting to develop their transition plans, which is going to shift their entire organization onto a 1.5 degree aligned pathway. And that will include engaging with Scope 3, engaging with supply chains, all the way down to the producers. So I do expect to see more rapid change in the coming years. So any more questions? We've got one, two. Lady at the front.
Thank you. Cécile Bicari from Contrast Capital. Thanks a lot for all the very interesting examples. My question is about the type of investors that you're trying to attract into these products once you're making them investable. I just wondered if you could elaborate a little bit on that. And more specifically, are you looking primarily for institutional investors, or are you able to design these products to be also suited for retail investor potentially, or family offices? And if not, what are the challenges around that? Thank you.
So in the interests of time, can I suggest one person answers this, and then we'll, rather than all three? So, Jose?
Mostly family offices. Those financial mechanisms, they demand a very patient capital. When you talk about pie economy, for example, our funds is 10 years, 12 years. It takes a long time. Not that we start paying 10 years, we start paying 2 years, but even so, they demand a patient capital. So we see a lot of family offices, a lot of corporate venture philanthropies joining the conversation. Institutional investors, so. But even so, when you look at the amount of capital that is still locked for this kind of investments, there are plenty of capitals. I don't think there is a capital shortage. Currently, we have more capital available than projects to allocate. And about retail investors is for sure something that we need to discuss, but most of the times they want liquid products. And I don't see a space for them in this scenario. But what we are doing is creating some other funds that could invest on senior tranches of those vehicles that have more amiable conditions for the retail investors. So you need to make an ecosystem of funds for each kind of capital. You will not only be corporate venture, you have to be blended finance, not just DFIs and commercials, but among all the different kind of capital that we have available, we need to be much more creative than we are now.
Thank you. And last question, gentleman in the blue jacket, and then we'll have to wrap this one up.
Yes, I have another question to José Bugas. My name is Philipp Staudacher from Radicant Bank. You mentioned you had unbankable projects and then you gave them a bit of love and they became bankable. Can you be a bit more specific? You know, where did you have to, which wheels did you turn within the bank, or what made them bankable all of a sudden?
Most of the times explaining to the financial sector how the project work. When someone, let's pick a agroforestry project for cocoa production, such as we launched at the New York Climate Week. To explain to a banker or to an investor that cocoa trees take 5 years to start producing, there's a need for cash flow, that you need intercrops, that you need cash crops, that you need that's this risk, and that he'll stop listening on the first 5 minutes. But if he's an investor, an asset manager, explaining to the same banker the same thing, is much different. They will take 2 hours learning about that. So to be the middleman explaining the problems on the language is not on the projects. If you can assume that bilingual approach to be the one translating the projects to the financial sector and translate the financial sector to the project, there is the kind of time and love that you have to put. It's the difficulty in blended finance, and blended finance is critical for any of the topics that we discussed here, is put people that have very different mindsets, very different mandates, that mistrust each other most of the time, to talk to each other and to build something together. So it's more diplomatic skills than financial skills that you need for those constructions.
Maybe just one quick comment, sorry, and which is that what we've seen in terms of bankability is that financial institutions are becoming more sophisticated in understanding blended finance, or the use of development capital and public capital, and secondly that they're starting to understand that revenue streams from items like carbon are monetizable and useful even as a collateral instrument. So that is a change in mindset that's happening as well.
So, can I invite everybody to give a round of applause to our 3 panelists as we invite the next 3 up? So, can I invite our next 3 panelists to come join me on the stage? As they're coming to join me, I'll just introduce their names. We have Thomas. I'm not sure I'm brave enough to try and pronounce your last name. Is it Hernesberborth?
I can't pronounce it either.
Okay, well, that's fine then. So we have Thomas, and we have Marta, and Adrian. So we're going to be looking at something slightly different now. These 3 panelists are going to be focusing on how to use a strong and robust environmental and social framework. This is that ENS framework up there, to ensure that you do get some positive impact from the investments. So I have a couple of questions that I'd like to direct to each of you to start with. And the first one is, how can you ensure that additionality is being delivered through your project? So beyond business as usual, and what's the role of the ENS framework in trying to push that needle for change? So I'll go again from close to far, and we'll start with you, Thomas.
Good. Well, thank you so much for having me and for that good but complex question. Look, what we think is interesting around nature-based solutions is that in theory, there's a much closer alignment between that ENS additionality and the impact you're trying to achieve and the actual economic returns that you're looking to generate as an investor. If you look at industrial assets, say I invest in a recycling plant, I generate certain revenue streams from the amount of waste I process, and then separately I can assess the employment benefits I'm generating, benefits to local communities, benefits on reduced leakage to the environment. But in a way, those are sort of the side benefits that do not directly form part of the economic model of that recycling plant. Now contrast that to a nature-based asset. Let's look at degraded land, for instance. Say you take a coffee plantation. A coffee plantation that perhaps hasn't been managed so well, the soil health is gone, very low soil organic carbon, no biodiversity, very few natural pollinators. That kind of asset, that kind of nature asset, is going to have a very low yield today, a very low quality. And now you begin to invest, and you start to turn that model around. Say you turn that monoculture model into an agroforestry model. You begin to plant trees. Maybe you plant some fig trees to attract various other pollinators, species, seeds. You start to create that biodiversity. As that happens, what you'll see is the actual soil starts to regenerate. You start to attract pollinators, biodiversity starts to increase, but as you do that, the yield of the land actually starts to go up. And what's interesting there, this comes back to my initial point, you get this perfect alignment between the ENS characteristics and the actual economic returns. You don't generate an economic return on that land unless you're able to improve the yield, unless you're able to boost the soil health, unless you're able to attack that biodiversity. So what's interesting in our mind around nature-based solutions is it brings sort of the financial rationale, economic thinking into nearly perfect alignment with the focus on ENS. They're not orthogonal angles, they're actually completely complementary and overlapping with one another.
So I'll ask the same question to Marta, and I'm very pleased to see we're both channeling green here. How are you ensuring additionality? And is there a challenge in communicating these benefits that Thomas has spoken about to the financial sector?
Yeah, I'll try to be very practical because I think that's what we are doing at the space right now in Brazil. So having the translation that Pugas just said and using this narrative, so what are the use of proceeds for? So how can we identify the different verticals in nature-based solutions? So for example, recovery pasture land, we have more than 100 million hectares in Brazil that is already degraded and could avoid huge amounts of deforestation. This is more than Germany and Spain together. So there's a huge opportunity to tackle this. And then going a little bit on the darker green, let's say, we will have integrated systems, agroforestry, bioeconomy, and livestock sustainable management. So we do have huge amounts of opportunities that we need the investors to understand what's one, or how each of them work, what are the differences between them, and then on their side, they have their own mandates. So for example, there are some players that are very willing to finance bioeconomy. We are currently working with Natura cosmetic company, financing the cooperatives in the Amazon region, which is very linked to what you said. So bringing the corporates in, it's a way of, they can be the aggregators, so it's a way of scaling. It's a way of de-risking as well, because they have commercial relationships with the people on the ground, and they originate and monitor. So giving back to your question, the monitoring of the KPIs, we'll have, it's a multi-stakeholder approach. We'll have also technical assistance together to help them. So there is another third party that is coming and that is measuring the baseline and then what's the impact that has been achieved as the time passes. So I think it's a quick overview.
Thank you. And how important is it, and I'll pass this actually to Adrian as well, is how important is it to engage with your clients on this as well? So measuring this additionality, ensuring this additionality, can it be done at arm's length?
Yeah, so in our specific case, we target companies that we can invest that are game changers and that they are willing to commit to do changes. Our process is that we follow a three-layer approach. One is that first we do a jurisdictional approach where we analyze what are the deforestation linked to such commodities and how is the sector going and how it drives deforestation. Then we perform an in-house analysis where we identify the potential transformational change that we can perform. And then we assess the feasibility of those commitments during our due diligence. Usually, because we provide long tenor loans, we can handheld kind of our investees because we set a set of environmental and social action plans that ultimately obtain these nature-based solutions, KPIs in our case, through maybe 8-10 years, and we are able to work with them every year in a close relationship, how they can improve their agricultural land, how they can keep protecting forest, adding reforestation areas. So we work closely with them. It changes because of the nature of the company itself. For some are big companies and they have the means and huge departments that provide sustainability information or capabilities. But some others are small or medium enterprises that doesn't have that capacity, and then we have to provide more help maybe or work closer with them.
So it sounds like it takes some time then. These aren't instantaneous solutions. And this comes to a second question that I'd like to ask is, related to your environmental and social framework that you've put in place, how do you monitor the impacts, or how do you use your E&S framework to work with your potential clients or the potential people that you'll be working with to monitor the impact? And what are some of the challenges for that? What are some of the opportunities for developing this E&S framework? So I'll start again with yourself.
Sure, I think we use our framework actually in two ways. First of all, to strategize where we actually want to deploy capital, where we can actually expect to make the most marginal impact through our investments, and then, of course, evaluating whether it actually took place. So to give you an example of that, the way we're thinking of this is understanding firstly, what are the different nature-based solutions, or what are the different ecosystems we could invest in, which are the ones we could restore, which are the ones we could regenerate. Secondly, understanding the kind of ecosystem services that each of those solutions would then generate, and understanding the kind of markets that we can link that to so that we can see whether we can actually tie the nature benefit to an economic benefit. As soon as you start going to the project level, you need to go a lot more local. You need to start understanding where do you actually achieve the biggest marginal opportunity or marginal benefit. We've looked, for instance, in opportunities in Scotland and compared them to opportunities in the tropical belt. And the difference is vast, just in terms of the rate of growth, the rate of carbon sequestration, the rate of improvement in yields and other benefits that you can deliver. So we use that framework not only after the fact. It's, I think, as important to actually use that thinking and quite a structured process to actually decide, in a world of limited capital today and limited liquidity, where to put that capital. Then once you've invested, of course, verification is important. Some of that is on the ground verification. I think new technologies are also coming into play here. Geospatial analysis, we think, is a very exciting technology, partially at a project level, but also as an asset manager to screen more broadly, actually, across our portfolios. As soon as we know where companies have different assets and we can see where deforestation events are happening, where soil health is declining, to begin to associate that with the assets in our portfolios.
Great, thank you. We'll be going to the audience for questions shortly, so please get your thinking caps on and get ready to raise your hand. But Marta, I'll pass to you.
We have a different approach because we kind of source and structure the deals. So even if we do have our own framework, we need to kind of work backwards because it really depends on the investor. So we need to match their KPIs and what we think it's also useful for that case, and how can we really measure and make sure it's we gather the information correctly, we measure correctly, and we do have multi-stakeholders. So sometimes we have information that we are the first source, but other times we do have information that comes from the technical assistance company and the corporate that is originating the deal or the collection agent. So we really rely on different sources of information, which is kind of tricky at the same time. But we do have our own criteria that we match to make sure that things are right, you know.
Fantastic, and over to you.
Yeah, us and Green, we have a MRV, a monitoring, reporting, and verification framework that we discussed previous to contracting with all our investees to make sure that what we are trying to monitor towards our KPIs is feasible for them. Where can we work together to help and monitor it? And then we come to an agreement of which type of KPIs they are comfortable reporting, where we can help. Secondly, our approach is a landscape level approach, so that makes things a bit more complex. Usually our investees have a lot of information within their assets, but not at landscape level. For that, you need to gather more information that sometimes is challenging. Then there's a differentiation. Some of our KPIs can be easily monitored through satellite. That helps a lot. Remote sensing, everything done by from your desktop. And then we have some other, like specifically social KPIs that are more difficult to measure from away. You need to get reliable data from the field. And these challenges are what we mostly faced. Yeah.
Thank you. There's so many questions I'd like to ask about that, but I will give the audience a chance here. If there's any questions from the audience for anybody, there's a lady here, a lady there. Start with you.
Hi, everyone. I have a question about foreign exchange risk. So when you're a project developer, a lot of the funds that are available for these kinds of projects, they're all in US dollars. Turns out some of our purchases are in Colombian pesos or in reales. Okay. What's being done to address that issue? Because the burden is oftentimes placed on the project developer. And when you go out and hedge it, it's an extra 8%. So can we please talk about that? Because it's a huge limitation for everybody. So to this panel, to the other panel. Yeah.
It's a fantastic question, and the question is about how do we address foreign exchange risk? I mean, I'll throw it open to the panel if anyone wants to touch on this one. It is a challenging and contentious area, and there's different views about who should be taking on that risk. But does anyone want to take this one? Marta?
It's impossible to hedge FX today because it's too expensive. And when we do securitization deals, the securitization structure, it's really, we cannot use futures because we don't have margin calls all the time. So we use call options. And this is economically feasible when we are talking about pre and post fixed. So this is what we hedge today. But FX it's really struggling. And what we are looking at today we don't receive any foreign capital in a huge amount that we really need to hedge. So it's not a current problem. But if we do attract international capital, Brazil, it needs to receive in order to do the transition, we will definitely have this problem. And then I think we should have like BNDES or local development bank or multilateral agencies or others that provide guarantees that do not require cash disbursement. And then it's easier for them to have this kind of FX protection. Or those players that I mentioned providing guarantees to the bank and have the underlying assets as a guarantee to themselves. So then we can have a bank or a third-party provider having the FX and the swap rate, and then backed by a AAA guarantee.
Anyone else want to take that one? I'll go back to the audience. Thomas?
I can add one thing. Look, this is a huge issue in an individual sort of portfolio or nature fund. Where it would be less of an issue, and potentially even a benefit, is in a much larger, diversified, balanced portfolio that many institutional investors, for instance, would have, where today the allocation to nature-based solutions is zero, exactly zero. Today, land systems account for around half of inflows and outflows of emissions, but only 2% of finance goes to some of these assets. The actual allocation that you would want in some of these large, diversified, balanced portfolios of, say, pension funds, even if that was just 1%, would represent a huge inflow into nature-based solutions, but that level of exchange rate risk in what's actually a very small part of a much more diversified portfolio is more easily manageable. So a lot of this discussion is not only how do we create individual funds, but how do we put this into a much broader asset allocation discussion.
Thank you. And there was a question from the lady in the front.
Thank you very much. I've been working in the sustainable finance impact investing field for a while, but I don't come from a finance or business perspective. I come from an international relations and particularly global development, climate, humanitarian affairs perspective. I was intrigued by the title for this session because the notion of a robust E&S framework, to me, begs the question of whose definition applies. And we heard at the beginning of this conference restatements of we know how urgent, we know how complex, we know what to do, we know we've got the money. But almost every session that I've been to has been the 10% applying the solutions that are available for the 10% without regard for what others are calling for around regenerative agroforestry, redistributive justice in terms of rates of return across the supply chains, restorative, not just to reduce the amount of damage we're doing, but to actually start to build back. So I suppose my question to the panel would be, while it is easy to do your due diligence, to calculate rates of return, to persuade an investor in the 10% market, are any of you engaged in working with groups that are working in the majority tercile of the economic pyramid, where there are rates of return, but we need different metrics, and we also need more support in putting proposals together? Because I've been volunteering for the last 5 years, and I can assure you it's not a good formula. But I do know of excellent projects where we've come to these meetings now 4 years running, and we've been told by investors, you don't have any decent projects. Well, that's because I don't have the resources that you have at your disposal. But there seems to be no meeting point on this bridge that we're meant to be building, where there's a little bit of assistance from the wealthy side of the bridge, so that groups who are working with community-based approaches, community-owned energy, water waste, farming, forestry, tree planting, etc., we don't really get a look in. So I'm really keen to know how these issues surface in your portfolios. Sorry to take so long.
No, and that's a great reference to why we're here, the building bridges between the different organisations. Now, I might pick on Marta, because I know that you have been doing something in this space. So the others, feel free to jump in. This will have to be the last question, I'm afraid, but Marta, would you like to talk about this a bit?
Yeah, I think there is not a silver bullet. So we'll need to have many different approaches. One is, for example, BNDES, again, the development bank. They had a call for proposal last year in Brazil for blended finance. It was the first time a development bank in Brazil and in Latin America does this. They had 90 million reais, which is $15 million. So they had this amount of money to invest in first loss trenches across different structures. And they said, how can I leverage the most? So they sent this call for proposal very open. They were open to what the structures were, vehicles, instruments, kind of if it was a first loss, a guarantee, a partial guarantee, or how they could leverage with other players, both concessional and private capital. And then they ended up receiving 50 proposals. They selected 11. They are still struggling to make it happen because the government changed, so it's late. And then this is the thing in Latin America. We need to work with what we have. So I think we get more creative as time passes. And then what we've done so far is, for example, corporates that are already aligned. They have interest in financing their supply chain because they have commercial interest in getting there stronger. They are stepping in. And then we have other players that are stepping in that are not impact investors, traditional market investors, because we have traditional market returns, so they're stepping in as well. So maybe creating this puzzle and aggregating the pieces as the project comes, you know, because we cannot have, we are working on what CPI Lab, the Climate Policy Initiative, in a master fund, super transition vehicle. The market is not ready for this yet. So we need to, it's a long term, and we need to have patience.
But we don't have long term, that's the issue.
Yes, long term needs to be 1 to 2 years.
Ideally, we would have started everything 20 years ago, but we are where we are.
Can I end on an optimistic
yes,
note?
Please do.
So we are optimistic on this. We believe that nature finance, which is really what we're talking about, is a little bit today where investments in renewable infrastructure were 20 years ago. 20 years ago, you were to talk to investors and tell them that as of today you would have entire cities running on renewable power. That would have been a bit of a cuckoo idea. Today, the idea that nature itself could be an asset in the same way that we are used to investing in real estate and renovating it, it's a new concept, but it is actually a concept that we believe the market is now actually ready for. Lombard Odier was started in 1796 at the start of the Industrial Revolution. 3 months ago, we announced the formation of Holistic, which is a partnership with one of our partners, Systemic, and specifically has one of its targets, nature finance. That timing is a bit intentional. We believe right now the timing is there at that sort of nature revolution. We're seeing a lot of movement in the markets. We're seeing the frameworks come out, the flag guidance from SPT. We're seeing some of these big, fast-moving consumer goods companies starting to take this more seriously, partially because of the climate mitigation issue, perhaps even more so because of the climate adaptation issue. That is becoming more visible, more acute, and is actually starting to drive some action. So from our side, we certainly believe there's enough momentum for us now to move in. The pilot projects have been run. The challenge is now to scale up, and we believe that the demand is there.
So I'll just wrap up very quickly here and then bring on my colleague from IUCN who's going to close. The nature-based solutions have been around for a very long time, but there's so much interest in them now, and there's so much opportunity. The pilots, as you said, they're working. The next step is to scale up, to bring the investors in at scale, to make sure that the benefits are flowing through to those local communities. And I do think that there's sufficient momentum for this to have an enormous impact. As I said earlier, 37% of low-cost sequestration needs can be met by nature-based solutions by 2030. It's huge. So I'd like to bring my colleague on who will close the session for us here from IUCN. And I'd like to thank again my panelists here.
Is this working? Yes, it is. Let me move over here. Thank you so much, Rachel. Thank you so much to the panelists that we've had today for the wonderful and really important discussions. I'm Jailan Malat-Bates. I'm at IUCN, overseeing blended finance initiatives, which include as well nature-based solutions. Just kind of a quick close and just kind of some of the key takeaways that I hope will, our additional thoughts and inspirations. We spoke about the integral role of blended finance for catalyzing capital, but how the private sector also really plays a key role, not only because of the financial resources that it brings, but also is its key role as a multi-stakeholder collaborator and mobilizer as well. So that's really, really important. And I think collaboration in a lot of the panels, across the last 3 days has been repeated. Certainly across a lot of the conferences these past years has been repeated a lot. The need for all stakeholders to learn to speak each other's language and learn from each other in order to not reinvent the wheel. The solutions are there, and we've heard from some of the distinguished colleagues who are at the forefront as well, who've overcome some of those challenges. So really kind of exchange and knowledge and collaboration is really, really important. It was mentioned earlier, knowledge and education are power in navigating risk management, but affording us also a mindset change in order to perceive those risks as opportunities, and that's really, really key. Failure is our friend. I can tell you, as being an ex-fintech entrepreneur, there's no shame in failure. That's how we learn and we share and our exchanges and our experiences, and it makes us richer, actually. Financial innovation and agility will accelerate us and afford us efficiencies. And lastly, we can't change what we can't monitor and measure. So really sound fund and project designs are really, really key. The idea of today's session, as you saw, is really a dialogue, so really thank you for the interaction and to Rachel and the panelists for bringing the interaction and for your rich insights as well. It wasn't intended as a one-off dialogue. From both UNEP and ourselves at IUCN, capacity building really is an integral part of the work that we do, and we work, both institutions, we work with different types of stakeholders, both private sector, public sector, academia, science, and we really engage and try and make the journey rich for everybody. So to that end, I invite you all, there's a QR code up on the screen to stay in touch with us. This is one discussion, but we hope to continue it on and have other private sector-specific as well dialogues. I know there's agriculture was quite an important one here, and landscapes, and to continue the discussion together, bilaterally, all together. And on behalf of my UNEP colleagues, on behalf of IUCN, I'd like to, for all of you to join me in thanking our distinguished panels that we had today, and Rachel. And thank you to all of you as well for your exchanges and pertinent questions. I think it's really, really important and to keep each other in check. So thank you all.